Good morning, everyone. Welcome to everyone joining us here in person and online. Today's agenda will be we'll start with a brief introduction. I got to get my back. Today's agenda, the presentation, we'll start with a brief introduction. Then we'll go into the rate setting process, including industry premium rates, the rate model, and then the transition from the old model to the enhanced model. Also want to take an opportunity to kind of set expectations regarding the information you'll receive from today's presentation. We will not be giving you 2019 premium rates today. We will show you a comparison of your 2018 premium rate under the old model and under the enhanced model, and some information of what is driving the differences. This will give you an idea of what to expect for 2019 when the transition is removed. We're providing this information to give you an opportunity to plan and prepare for a potential premium rate increase. Scheduled about an hour for the presentation and then questions after. For those online, you can submit your questions to askwcb at wcbsask.com. So your premiums, what do your premiums cover? As for employers, you fund the compensation system and are protected from being sued if there's a workplace injury. The premiums you pay ensure that workers are protected if they're injured on the job. They receive wage loss benefits, medical benefits, and rehabilitation benefits. The main objective of the rate setting process is to ensure that overall premium requirements of the WCB for the coming year are met. Premiums should cover all current and future costs for claims from employers operating during the year. This would include workers' compensation, so wage loss benefits, vocational rehabilitation benefits, health care, survivor benefits, the administration of the system, and the funding of safety associations. The rate setting process should also ensure the distribution of these revenue requirements across all employers is equitable. While maintaining collective liability, it should promote accountability and fairness and recognize injury prevention and disability management practices. It's important to note that the two key components that factor into the calculation of premium rates is claims costs and payroll. The costs associated with workplace injuries that have occurred in the past year help us project the future claims costs. The second key component of your premium rate is payroll. Payroll is collected for all workers in all industries subject to coverage under the Workers' Compensation Act. Premium rates are based on the ratio of claims costs to payroll. WCB is funded by the premiums employers pay and the investment income earned from those premiums. Premiums that we collect in a year cover all costs of claims that happen in that year. So if you have a 15-year-old that is severely injured, we will collect enough in 2018 to pay for the lifetime costs of that claim. An actuarial model is used to predict claims costs for the upcoming year. Actuarial models ensure financial stability and security of benefits. Costs include an industry's own claims costs as well as their portion of the shared costs. So when we calculate the costs for your industry and your premium rate, we're looking at your costs, a portion of your costs, as well as some of your costs are pooled, and then your share of those pooled costs. This slide shows a timeline of events that brings us here today. In 2015, the WCB conducted an asset liability study through an external consultant, Eckler. This study incorporated actuarial asset liability and investment return projections and recommended that the WCB review its rate-setting model and funding policy. So in 2016, as a result of the recommendations in the asset liability study, we did a review of the rate model. That rate model review was completed by the external actuary, Eckler. We received a report from Eckler in September of 2016, and then in October introduced the enhanced model to stakeholders during the rate-setting meetings. In November and December of 2016, we did province-wide education sessions to help employers understand the enhanced model. In February and March of 2017, we did industry rate employer education sessions that included information on the potential impacts of the enhanced model, and we consulted on how to transition to the enhanced model. In 2018, in October of 2018, we shared information on the 2018 premium rates and that plan to transition the enhanced model. The enhanced model became effective in January of 2018, which brings us to the sessions in February, where we're trying to reinforce for those rate codes that are potentially going up due to the changes from the old model to the enhanced model, reinforcing that message for employers and helping them understand why they were transitioned in 2018 and what it might look in 2019. Now, a basic overview of the principles at play here in the rate model. The premium rate setting process should appropriately balance these sometimes competing principles. The rate model should be robust and sustainable, satisfying the needs, goals, and expectations of employers while being actuarially sound, relatively simple and easy to understand, communicate, and administer. And it should ensure the security of benefits for injured workers. So the first two competing principles are accountability to the rate code, accountability to employers, compared to collective liability, which is the basic insurance principle. Premium rates paid, so under accountability and fairness, premiums paid by current employers should cover the costs of their injured workers during the premium period. This principle covers something called intergenerational equity, meaning current employers should not be paying for claims costs generated by past employers, nor should they be subsidizing the claims costs for future employers. This concept also covers something called intragenerational equity, which is employers that incur injuries should be responsible for the claims costs of those injuries. A fair rate-making model encourages workplace safety and effective return-to-work policies and programs by financially incentivizing employers' positive behaviors. Counterbalancing, or sometimes on the opposite side, not really the opposite side of that, but counteracting that, is collective liability, the basic insurance concept where employers as a group and or those within the same industry are jointly responsible for all workers' compensation costs. Employers should not be excessively punished for unusually costly claims. Thus, portions of unusually costly claims should be shared by all employers. So we have these competing principles of collective liability, making sure employers aren't unfairly burdened by unusually high-cost claims. Offsetting that is holding industries and employers accountable for the claims that are happening within their industry. On the other side, we have competing principles of rate stability and reactivity. For rate stability, employers should be able to rely on predictability and stability in their rates. On the reactive side, industry should expect quicker recognition of successful prevention initiatives and claims management practices. It should also be quick to recognize industries with poor safety performance. The whole model should be easy to understand, so should be transparent. So employers should be able to understand the factors that went into setting their premium rates, and the WCB should be able to clearly communicate this information to employers. This is the concept of WCB as an insurance program is no different than the insurance program to cover your vehicle or your house. You pay premiums, something bad happens, the collective liability, there's a pool of money there that will be used to replace your car or replace your house if something bad happens. Having said that, those that have more claims or higher costs will tend to pay more premiums than those that don't. I'm going to walk through the basic components of this enhanced rate model. At its highest level, the key drivers of premium rates are still costs and payroll. The enhanced model changes the way we estimate those costs for the upcoming year. The following 6 components impact industry premium rates under the enhanced model. So a high-level overview of these 6 components of the enhanced model. The first one is credibility of industries. Credibility is the extent to which we can use past experience to predict future experience. Under the current classification structure, there are a number of small industry rate codes with lower credibility, making it difficult to predict future claims costs. And D73 would be one of those rate codes with fairly low credibility, meaning there's not from, if we look within a 5-year period, there's not a lot of costs in there to accurately, there's not enough costs in there to accurately predict from one year to the next. So the change for rate codes that are not fully credible, their experience should be complemented with a longer experience period. For example, using up to 10 years experience instead of 5. We will no longer, so what we do in the past is if there was a low credibility rate code, we would augment their experience with the board level experience. So what does this change mean? It adjusts credibility to use more of an industry's own experience, holding them more accountable for their own experience. It achieves a reasonable balance between reflecting recent experience and reducing volatility for smaller rate codes. So this improves predictability. An example how this enhanced change will work is if 5 years of costs, so let's say D73 had 5 years of costs, their cost history was 80% credible. 80% of the we'd use 80% of the 5-year experience and then 20% of the 10-year experience. The second component is the use of indicators to predict costs. Under the old model, we projected the number of time loss claims and the expected future costs associated with those claims. The concern with this method is that the number of claims has been declining for most, if not all, rate codes, but there has not been a proportional decline in costs, particularly when we look at long-term claims costs. So our ability to predict based on the number of time loss claims, that correlation was not strong anymore. So we had to look for a correlation that could more accurately predict costs going forward. So the change was the use of something called evolution of workforce, not the number of time loss claims to determine future claims costs. The evolution of workforce considers the change in the number of injured workers in a rate year to estimate future costs. So if it looks like you're going to have more workers in your industry, then we assume that your claims costs will go up with it. If we're predicting fewer workers in your industry, we're going to predict that claims costs will go down. This change increases rate stability, and it makes it easier to understand how we're predicting your claims costs, whether or not they're going up or down. The third component is costly claims pooling. Cost pooling is when costs are spread amongst a larger group of employers. For example, certain costs may be allocated at a rate code level or amongst all employers in the system. This increases collective liability so that a group of employers are not unfairly burdened. The old model pooled pension costs above $90,000, and it pooled those costs at the class level and then redistributed them as a fixed percentage of your payroll. The change is we would apply pooling at the level of 3 times the ultimate maximum wage rate as a better balance between industries being accountable for their own claims and collective liability for those rare, high-cost injuries. Costs in excess of 3 times the ultimate maximum wage rate are pooled now at the board level and allocated back to industries based on the industry's proportion of costs. And right now, the maximum, 3 times maximum wage rate is about a little over $252,000. So the first $252,000 will be factored into, or will stay with the industry rate code. Anything over and above that will get pooled at the board level. All those pooled costs will be redistributed back based on your proportion of costs in the system. This increases collective liability. It improves predictability and rate stability and makes it easier to understand where the costs are coming from. The fourth component is allocation of fatality costs. Under the old model, we averaged costs of fatalities and allocated them equally to each rate code based on a 10-year average. The change is all costs arising from fatalities will be charged to the rate code in which they occurred and treated like any other claim, which would be subject to that claims costs cap. So roughly the $252,000. This increases fairness because those industries that are having fatalities are going to be held accountable for those costs. The fifth component is long-term claims. While projecting future costs, the old model considered costs paid during the past 5 years for any claims that occurred in the past 50. So if you had a claim that was 50 years old and it incurred some costs within the last 5 years, we would capture those costs. The change now is we would apply all costs for the first 7 years of a claim to the industry experience. Remaining costs are now pooled at the board level and allocated back to industries based on the industry's proportion of costs. This increases reactivity by putting emphasis on an industry's most recent experience. Increases accountability for industries for that most recent experience, and increases collective liability for old claims costs. Because for most industries, many industries, the nature of injuries change, the employers change, technology changes, safety, return to work programs change. So by suggesting that what happened 40 years ago is going to somehow happen again, by capturing all those costs, just wasn't happening. So by focusing more on recent cost and recent experience, we're able to better reflect and react to what's happening in the industry. On the flip side of that 43 years, the other 43 remaining years of claims, that long-term tail, that gets put up, all those costs get put into a pool and then redistributed based on your proportion of costs in the system. The sixth component is allocation of administration costs. The change here was an increase in the fixed component of administration costs from 10% to 30% to better align with the allocation of fixed and variable costs as it actually happens with WCB. So in the past, we had 10% fixed costs, 90% variable. When you looked at our overall administration costs, about 30% of our administration costs were related to what we'd call fixed costs. IT, human resources, registering employers, collecting premium rates, the things that connect to those fixed basic costs of operating the business and or activities that all businesses share a cost in. Approximately 70% of our administration costs are variable in a sense that we charge employers, it's the costs associated with managing claims, and those employers that have more claims are being charged a higher portion of that variable cost. So fixed, the increase in fixed, the 70-30 is more reflective of the way our administration budget really is spent. And so we changed it from 90% variable and 10% fixed to 70% variable and 30% fixed. The overall amount is roughly the same. It's just how we allocate those costs. The fixed costs are redistributed based on payroll, and the variable costs are redistributed based on claims experience. So the enhanced model was implemented in 2018, and after customer consultation, the board decided to transition the impacts of those whose premium rate would increase under the enhanced model, but for 2018 only. The move to the enhanced model for some industries, and there's 14 rate codes that would see an increase as a result of moving from the old model to the enhanced model. So to mitigate, for those 14 rate codes, to mitigate the impact of those increases, the WCB drew from the injury fund to cover the costs associated with the transition. The board's funding from the injury fund will cover the difference, or did cover the difference, between what an employer would have paid in 2018 with the enhanced model versus their final 2018 premium rate. Those industries whose premium rate decreased under the enhanced model, so there are roughly 50 rate codes, so 36 rate codes saw their premium rates decrease under the enhanced model. For those rate codes, their premium rate was exactly as it was calculated under the enhanced model. Starting in 2019, all industry premium rates will be determined under the enhanced model. No further transition will be provided. So just a couple of examples of how we transitioned rate codes, just so you can understand how your rate code was transitioned. There were two basic methods we used. So this slide shows the two examples of how rate codes were transitioned. The reason for the transition, again, was to give employers and industries the opportunity to adjust through 2018 to what they could be paying under the enhanced model in 2019. To be considered for a transition, the premium rate under the enhanced model was higher than the 2017 final premium rate. Once a rate code was identified as a transition rate code, their premium rate for 2018 is determined in one of two ways, was determined in one of two ways. Example one, the 2017 final premium rate was $1. There was to be an increase to $1.30 under the enhanced model. So there's that potential increase of 30 cents. Transitioning means we continue to use the old model to calculate this rate code's premium rate. And in this case, the old model provided a premium rate that was higher than 2017, but lower than the 2018 enhanced model. So the industry premium rate would have been $1.20. In example 2, again, we're starting off, 2017 had a premium rate of $1. It should have increased to $1.05 under the enhanced model. So we ended up using just the 2017 level and kept it at $1. So we would have transitioned 5 cents for this rate code. So there's one of two ways we looked at it to try and cushion the transition from 2017, from the old model to the enhanced model. Industry impacts provided in this presentation are comparing the 2018 premium rates from the old model to the enhanced model. So quickly we're going to get into exactly how the enhanced model is changing the way you pay the premium rate for your rate code. The intent of providing this information is to educate you on the model changes and give you a sense of the impact of changing from the old model to the enhanced model and what you could be paying in 2019. Final premium rates for 2019 are not final, but draft premium rates, let's say, for 2019 will be released or provided in October during our rate setting meetings. Now, as you look at the model and the different components and the impacts of those components based on the changes to the enhanced model, it's important to keep in mind that it's difficult to isolate one impact from another. So the model works as a system, and all the parts of that system, components of that system, work together. So you can't just change one without maybe potentially impacting other components. So let's look at D73. Under the, so the red bars are what we're suggesting from changing from the old model to the enhanced model. This is the impact on each component. And I'll go through a kind of a high-level overview of why that impact is the way it is. So when we talk about credibility, and again, this is our ability to predict, take past costs and predict future costs. Under the old model, D73 was 40% credible. So, and again, because it wasn't 100% credible, we would blend their experience, your experience in D73, with the board level experience. By removing that, this actually has an impact of, because your experience was typically better than the overall board experience, it would actually cause, removing that blending would actually cause the premium rate to go down. However, when we apply the enhanced model now, under the enhanced model, D73 is 56% credible. So we'll use 56% of the first 5 years and 44% 10 years experience. And in D73's case, the 10-year costs are higher than the 5-year costs. That's what's pushing up this component of credibility. We're pulling in older costs. 44% of it is the 10-year cost, and that's higher than the 5-year costs. So part of this is it's a fairly small rate code, and in order to get enough claims costs data to predict past to future, we have to look at a broader window, a 10-year period versus a 5-year period. And the older claims appear to be more costly than the newer claims. The change of indicator. So from 2006 to 2016, there has been a sharp decline in time loss claims in the rate code. So under the old model, this means that time loss claims caused our rate model to expect a corresponding or a significant decrease in claims liabilities. But as we know there has not been a corresponding decrease. The rate at which time loss claims have dropped is not the rate at which costs have dropped. Using workforce will cause the rate model to expect a decrease in claims liability that is more in line with the slight decrease that's happening in the industry right now. However, this decrease is much less subtle than when we use time loss claims to predict costs. Therefore, the adoption of workforce as an indicator will increase this component of the D73 premium rate. So the old way we used to predict costs was using time loss claims. Time loss claims are dropping quickly in this rate code, but costs were not dropping as quickly. So we're getting a bit of a false sense of how much costs would drop. Using workforce, it's highly predictable in predicting costs. And when we look at it, D73 is trending down a bit right now in terms of workforce. So we are expecting costs to slightly drop. But the difference between calculating it through time loss claims and calculating it through workforce as an indicator causes this component to jump up by 6 cents for 2018 only. The other three, and I can go through them if anybody wants, but I'm going to jump over to, well, you know what, I'm going to go through these quickly because it's important to understand that there's kind of puts and takes through the whole system. Under claims cost pooling, under the old way where we just averaged pooled pension costs, the average pension costs for hard rock mining were 8% higher than the average D sector pension costs. So pension pooling used to create a benefit to the rate code. Your costs were higher, you would pool it all. What you took back out of that pooling was actually less than what you put in. It's the same thing happening with costly claims pooling when we switch to the the enhanced model. Costs in excess of 3 times the max are 89% more or higher than the board average. Therefore, pooling costly claims causes a decrease in your premium rate. So you're putting in a lot more at the board level than you're taking out from a collective liability perspective as a rate code. That's causing a drop in your premium rate by about a penny in 2018. Fatalities. There was one fatality in D73 between 2012 and 2016. But obviously that fatality from a cost perspective doesn't impact the rate code as much as the old model. Therefore, there's a 2-cent decrease under fatalities. Under long-term claims, this is similar to the costly claims pooling in a sense, in that the D73 has a larger portion of costs in the long term than the average board level. Therefore, pooling those costs are going to decrease, have a negative, positive impact, decreasing your premium rate by 2 cents. So again, D73 is putting more, their costs in their long-term tail of their claims are higher than the board level, so they're putting more costs into that and taking less out. The final component is administration. Under the old model, so we split fixed. The fixed was switched from 10% fixed under the old model to 30%. That change causes your rate code to go from 3 cents for fixed to 9, almost 10 cents for fixed. But under the variable, under the old model, you were paying almost 20 cents, 19.8 cents, for variable or claims cost related administration. Under the enhanced model, you're paying 16.9 cents or almost 17 cents. So the net impact of those changes means you're going from 23.1 cents, that's what you'd pay for your fair share of the administration, to 26.8 cents. So this slide shows an illustration of how your premium rate was transitioned in 2018. As you can see, the 2017 premium rate for D73 was 79 cents. The old model would have produced a rate of 78 cents for 2018. The enhanced model produced a rate of 86 cents. The 8-cent difference is what we just walked through on the previous slide, all those components. The final rate that you paid for 2018 was 79 cents, as we held it at the 2017 level as part of the transition. This means that 7 cents was covered from the injury fund for 2018. So what does this mean going forward? All things being equal, your 2019 premium rate would increase to 86 cents. In order for that to happen, the claims costs and payroll for all industries would need to remain the same, which is not likely to happen. But it still gives you a sense of what might happen in 2019. The 2019 premium rate is going to be dependent on your experience and payroll, as well as the board level experience. So if the board level overall experience worsens while your industry experience improves, in theory, the industry could still see an increase because of the pooling applied to costly claims and long-term claims. In addition, the industry share of the risk will be dependent on the ratio of your costs compared to the overall costs. The updated experience will essentially determine the degree of change you'll see for 2019. So what's next? Today's presentation is being recorded. It will be available on our website for the next few days, and then transitioned over to our YouTube site where you can see it, review it if you want at a later date. As you review the information presented today, you may have questions down the road, so please contact us, and you can submit those questions to askwcb@wcbsas.com, and we'll get back to you usually within 5 business days or a week. For those attending online, we'll provide, you can send any questions that you have at askwcb@wcbsas.com. And a reminder that the 2019 preliminary premium rates will be available in October, once we've got the updated experience for the industry available. Just a reminder that I know this industry understands quite well, but obviously you can influence your premium rates. The ultimate goal really is mission zero: zero injuries, zero fatalities, and zero suffering. Injury prevention is the best way to minimize costs and human suffering. Having appropriate safety programs in your workplace can be an effective tool to injury prevention. Having effective and appropriate return to work programs can also help minimize costs and influence premium rates. And there are many resources available. I know for the mining industry, the Saskatchewan Mining Association has a safety committee. The WCB has account managers that can help with questions. We have the WorkSafe website. There is classroom training available through WorkSafe, as well as online training and resources available through WorkSafe. So thank you to everyone here and online for your attention to this presentation. This brings us to the formal, kind of a close to the formal part of the presentation. So we'll now open it up to any questions that people have. And if there are questions, if you wouldn't mind using the mic so that anybody online can hear your question and the response. So on behalf of WCB, I want to thank everyone for attending and any questions that you may have. So I'll just kind of open it up now. We'll go. Any questions online? None online yet?
There's
Okay.
none yet.
Do you have a question? Nothing? No? Okay. Okay, so just a reminder that some of this information, if the whole rate model itself, we kind of went at a high level at the rate model. This is just a review of the transition and how things might look in 2019. There are more detailed, there's a white paper on our website. There are YouTube sessions on more detailed information on how the rate model itself works. They're available. Again, if you've looked at some of this material and you still have questions, just contact us and we'll do our best to answer any questions that you have. I realize that sometimes you need a few days to think about the information that you've received and kind of formulate your questions. So with that, I want to thank everyone for attending today here in person and online. And for those, if you're traveling, safe travels home. Thank you.